And welcome to the Afrinvest webinar series. My name is Damilare. I'll be the host for this webinar. And I mean, it's not out of place to say Happy New Year, since this is our first webinar in the year 2024, the first of many. We hold webinars every quarter of the year. What are we going to be talking about today? We're going to be talking about building your assets with private investment trusts. So, I mean, for some of us, you've heard what trust is. You've had trust, you've had private trust, but then you're hearing private investment trust. So what does it mean? What are these guys up to? Calm down, we will explain. So this webinar is going to give you a full detailed explanation about private investment trusts, about how to build your wealth, your asset from, from ground up, basically. A lot of people have heard about private trusts being for the high and mighty, right? Being for the far end of the of society. But this product is tailored to cater for everyone within the economic spectrum, whatever you may be. This product is, well, I like to call it, this product is kind of like the in favor of the common man, if I may. Okay, so irrespective of what you earn, where you are in your economic journey or your financial journey, this product is here for you. And as usual, we have, I'm going to introduce my colleagues who are going to be taking us on this webinar. I'm going to start with Ebonluwa Tubobo and Chisom Uwogo. I mean, for those of us that are OGs before IGs, you know how we always deliver now. So, you know the drill. Use the comment section, use the question and answer section if you have any questions. Towards the end of the session, we're going to create we are going to allocate some times for question and answer. So just feel free to drop in your questions. Use the chat section, use the question. We'll try the question and answer section, okay, so that we can have it in one place. So again, welcome again to our webinar series. I'm going to hand over to Ebonluwa. Over to you guys. Just strap in your seatbelt. You're in for a ride.
All right. Thank you very much for that fantastic introduction, Damilare, as usual. So as Damian said, right, you've been with us throughout the last year. We've been talking about trust. We've been talking about estate planning. We've been, we've almost sounded like a broken record when we're trying to explain the concept of trust. But today we are trying to, look into what a private investment trust is, the fundamentals of a private investment trust, because we've looked at, the current state of things, and we've come to the actualization that, okay, why don't we have a product that can fit the common man, that doesn't necessarily need to be for the elite or for the HNI. So during the course of this presentation, we'll be going through private trust fundamentals, we'll be going through investment fundamentals, we'll also be going through the private investment trust versus traditional investment options, the pros and cons of integrating private investment trust into your wealth building strategy, practical steps to initiate and manage your own private investment trust, and obviously our contact so that you can reach us at any point in time to set up your trust, or if you have any questions or clarifications. So basically, private investment trust. I usually, when I like to speak on topics like this, I like to start from the ground basics. I like to start from the elementary part of what I'm about to talk about. So, we've understood the concept of a trust, right? But we need to also, understand what exactly even compromises of a trust. How do you even, bring about this trust idea? And one very, very important terminology is what we call your estate. Your estate is very important when it comes to having a trust, having an estate planning, even your will. There is a terminology called your estate. And what's your estate? Contrary to the popular opinion that we may have of what an estate is, that is your basic real estate property or your basic landed asset, right? Your estate is actually, basically all your worth, right? Your money, your property, there is everything that you own. Some may even call it assets, capital, holdings, fortune, but it's all encompassing. That's just basically what I need us to understand when we're talking about estate, when we're talking about estate planning, because whether you like it or not, everything relating to, what we do here is you having to plan your estate, you having to plan for the future, you having to, create a very good mechanism around your estate. So moving on, we've identified what an estate is, and then we're trying to say, okay, for your estate, you need a trust. So what is a trust? What then is a trust? What is this trust concept? And for many of us that have been listening to us, I'm sure you'll probably be able to even lecture us or give a much more detailed explanation that I would as to what a trust is. But for the new joiners, a trust basically, in the most elementary way as possible, is a three-party agreement, right? Where you have somebody say, you know what, I have this car, I have this cash, I have this house, right? I want to create something that I can be able to, leave behind this particular asset, this particular estate for my beneficiaries. And I just don't want to leave it with any friend or any neighbor. I want to leave it with somebody that I know that is independent, is neutral, has no ulterior motives towards this asset and estate. And that is where the trustees come in. So in a trust, right, you, who will call a settlor in this case, a settlor is someone that sets up a trust, basically says, you know what, trustees, Afrinvest trustees, I want you guys to manage this thing, because not just for the fact that I don't think I can manage myself, but I believe and understand that you'll be able to transfer this asset to my beneficiaries seamlessly. You'll be able to transfer this asset to whoever I love seamlessly, and that's the beauty of a trust. So there are many benefits of what a trust can do for you, right? There is the speed and confidentiality of execution. When we're talking about estate planning, there are different ways by which you can plan your estate. We have the trust, we have the wills, we have the power of attorney, we have different methods. But for a trust, the reason why we say speed and confidentiality is because, unlike a will, if you need to execute your will, or if you need to bring your will to life, right? Let me use that word, because obviously you execute a will, and then if the person passes on, you then have to actualize your will. And because of actualizing your will, you would have to go to probate, or obtain your grant of probate, do this, do that, ascertain the assets here, and it can be a whole lot of delay in getting your assets to the beneficiaries. But in terms of a trust, you create a trust deed, a contractual agreement, basically, and say, trustees, I'm giving you my asset, so this asset is going to my beneficiaries, right? And the trustees, based on that contractual agreement, based on that trust deed, right? The in our own world, we call it a trust deed, that contract between you yourselves and the trustee. We call it a trust deed. And you said, okay, and all of these things that you want is already incorporated in trust. So the trustee just has to disburse, just has to seamlessly give those assets to your beneficiaries. And that is the speed and the beauty of having a trust. The confidentiality aspect of it also is brilliant. A trust cannot be picked into, unlike a will that if it's read, if it has been read by the probate registrar, it immediately becomes public. Anybody can easily go and see what is in your will. And a very typical example which I like to use all the time is the will of Ganifre. I mean, in fact, that's even one of the first most comprehensive wills I've ever read during my time of my career, because you could see how well it was able to structure its asset. But regardless, it was still public. But unlike a trust, it's very confidential. Whatever agreement you're having with the trustee stays with the trustee and within the habits of the trustee. Reduction of administrative costs. A trust is very effective. Like I said, it doesn't have to go through probate where government will say, okay, you know what, I'm entitled to 10%, I'm entitled to this percent, I'm entitled to that percent. Once your asset is in a trust and you want to bequeath it to the beneficiaries, all the trustee just need to do is transfer those assets to the beneficiaries. There is no need for any probate or having to go to any court or anything. Tax efficiency, right? So a trust in its element cannot basically be taxed, right? So a trust has this advantage of not being taxable because of the whole idea behind why that trust exactly was created, the whole idea behind the objective of what a trust seeks to achieve, right? So there's also elimination, reduction of disputes. Once you've been able to ascertain and say, okay, you know what, my beneficiaries, I have a trust. This trust, everybody has been apportioned a particular ratio of how the assets to be distributed. It reduces the dispute. It reduces the possibilities of acrimony in your family. Also, the opportunity for a test run during the lifetime of a settlor and ability to make changes. Unlike a will where, at every point in time where you need to make a change to the will, you have to go to the probate, you do a codicil, or if the change is maybe very, very material, you may even just want to, just do an entire will in its own, right? But for a trust, like I said, it's contractual. It's basically between you and the trustee. There is no relodgement of the will in probate, of the trust deed in probate if there's any issue. All the trustee just needs to do is to do an addendum or to make certain amendments to the trust deed, and then the trust continues to run as normal. There are also other benefits that a trust gives. Like I said earlier, avoids probate or any estate tax, right? A trust does not go through probate. A trust is basically between you, yourself, the trustee, and then for the benefit of people you love, who call the beneficiaries, people you want to inherit your assets. So any of those probates, shenanigans is non-existent in a trust structure. The professional asset management, obviously, your trust is being managed by professionals. For you to even become a trustee in the first place, you need to be licensed by Securities and Exchange Commission, which obviously has specific guidelines and laid down rules that you as a trustee must follow. So you obviously have the peace of mind knowing that your assets are professionally managed. Asset protection, your assets to be protected, like I said, third-party interference is non-existent. Nobody can come and say, okay. In fact, there's no way they would even know you have a trust. That's the beauty of it. So nobody can come and say, oh, Afrinvest trustees, my brother has a trust, except if obviously there have been prior communication or that person is a beneficiary, right? But if the person is not a beneficiary, if the person has no local standard as to the trust arrangement, then nobody else can, pick or interfere into the specifics of the trust. Then obviously we have preservation of family culture, right? It also preserve family culture by you basically taking care of your family. So why should you have a trust? Why are we saying have a trust? Why are we saying, you need a trust? A trust also, it allows coverage over any class of asset, right? And this is in general now. This is not basically for the purpose of the private investment trust that we're trying to pitch today. This is what just basically like a general, understanding as to the beauty of a trust, right? Coverage over asset of any class. For a trust, you can be able to, link in your liquid, your fixed asset, or what have you, basically. Is to exercise powers. I've talked about you being the settlor, you being able to say, okay, this is what I want, this is who I want my trust to be. And a bit about the trust, a trust is bespoke. It's bespoke. It's tailored towards your own estate planning needs. It's tailored towards what you want to achieve, basically, right? And also assured independence in executing wishes. You as the settlor, I like to use the word alpha and omega of how you want your trust to be handled, right? So being that the trust comes with a trust deed, you are sure that whatever instructions you put in the trust deed, the trustee will have to follow those instructions to the latter. Incontestability by aggrieved relatives, just like I said earlier, any relative that upon one's demise that is not happy would probably not even know that the person that has passed on has a trust. So it's basically almost impossible for you to contest and say, oh, I'm supposed to be entitled to this, I'm supposed to be entitled to that, because what you don't know, you can't even argue about it, right? Flexibility to accommodate wishes. This also encompasses all of the same. It's very flexible. It allows you to tailor your trust to your own ideologies, your own way of life, and exactly how your family is structured, right? So if you remember my definition then, when I was trying to explain to you what a trust is, I mentioned, having a settlor, having a trustee, and having a beneficiaries. These are what we call the major elements of a trust. And if you don't take home anything, what you should take it today is that if any element is missing in any of these three, then what you don't have is then you don't have a fully constituted trust. For you to have a fully constituted trust, for you to even call anything a trust, these three elements must be present. And what are these elements, right? There must be a settlor, which is a term I've been using quite often since the beginning of the webinar, of this webinar. It's basically you creating the trust, right? In some other jurisdictions, they may refer to you as the trustor, right? But here, we use the term settlor majorly, right? So you as the settlor, you are giving your assets to another party is independent and neutral, which is the trustee. And in this case, obviously, Afrinvest trustees mean that we are more in a better position to, be your trustees and handle your assets. So what does the trustee do? It's basically an independent, neutral party, who is vested with the assets of the settlor. You are saying, okay, you know what, trustee, hold this asset, manage this asset, let this asset bring a return. Let's, let my asset be in your custody, because I believe and I know and I'm of the 100% assurance that if anything happens to me, this asset will go to the already named beneficiaries that are listed in my trust deed. And lastly, obviously, your beneficiaries, these are the persons for which we are doing all of this. These are the persons for which we are taking this initiative. These are the persons for which we are taking this bold step to say, you know what, I want to have a trust. I need to have a trust. I want something to be left behind for my beneficiaries. In as much as, yes, I may have a will, but, based on the bureaucracies that a will comes, and then as opposed to the seamlessness and the straightforward processes involved in the trust, I need the trust for my beneficiaries. I need my beneficiaries to have something that they can access whilst I'm alive, and even while I'm no longer here. Right, so we have different types of trusts, right? And this is before we go to the main subject of the day, the private investment trust. We have the living trust. I like to call this the mother of all trusts. It's basically, a type of trust where you can put in virtually every kind of asset, right? We have the blind trust. The blind trust is the kind of trust where basically the beneficiaries have no prior information. So in most trust structures, the beneficiaries probably have an idea of what they're entitled to. The beneficiaries have an inkling as to what is in the trust. But for a blind trust, the beneficiaries in most cases do not have any prior information. And all of this basically is dependent on the preference of the settlor. So we also have the education trust. From the word education, we could probably be able to even have an idea, right? So this is a trust basically tailored for the education of your tell us towards the education of our beneficiaries. Many parents, they want to be able to put away pool of funds and say, okay, I want these funds to be available for my child's education so that he can attain the degree of a master's or a doctorate degree or a PhD, basically any amount of level that you want your beneficiary to attain. And also your beneficiaries can also get welfare allowances through the education trust, right? We also have the charitable trust. The charitable trust, also from the word charitable, right? Basically just means the type of trust where people that have philanthropic, ideas, or people that are very passionate about giving back to society can create a trust and say, you know what, I want to set aside this particular amount of monies for this particular set of people. You may be sentimental towards people that are disabled, maybe sentimental towards people that have some sort of terminal illness. There are different reasons why someone may want to have a charitable trust, right? Going forward, we also have the testamentary trust. This is basically a type of living trust that comes into effect upon the actualization of a will, right? So in your will, you could say that upon my demise or upon my passing on, by the case may be, I want my beneficiaries to have access to this asset through a trust. So you are instructing whoever is going to be handling your will to create a trust, at the point by which the will is being read, right? So we have the celebrity trusts, also from the nomenclature celebrity, we can be able to do deals. This is a type of trust basically for high net worth individuals, for people who are very well notable in the public, right? This is a trust that has been specifically tailored for them. We also have the family trust. The family trust also is a kind of trust well, with the name too, so the whole concept of trust is very basically, easy to understand. It's just about you knowing what you want to achieve. So for a family trust, as you see, the trust that you create for your family, some people may call it family office, but basically it's also a family trust. It's for the family, all the affairs related to the family, the children, your whole family in its entirety, right? Asset protection trust. From the word also, we can also deduce asset protection. It's basically a trust tailored towards, asset protection. A very notable example that I like to use, which also spans across, which can also span across the different types of trust, is Michael Jackson, right? Michael Jackson was a very prominent celebrity who happened to have a trust, right? So his whole essence of creating a trust as at that time was definitely because of his fame and wealth. He realized that, he needed to shield his wealth away from scrupulous creditors or people that may have some sort of mischief towards his assets. And through that trust that he created, Michael Jackson was able to Michael Jackson rather was able to shield his assets away from people, and then ensure that his beneficiaries enjoys his assets. So it's obviously good for us to also note that these types of trust that I've listed, that are non-exhaustive. We have a whole number of trust, like I said, all of depending on the kind of estate planning that we're seeking to achieve or what we are seeking to achieve. So to the trust of the day, the private investment trust. Why are we talking about the private investment trust, right? Why are we bringing this ideology or this concept to people and telling people to have this kind of trust? A private investment trust basically is a kind of trust that caters to liquid assets alone. I need to take that again. A private investment trust, right, is a type of trust that caters to liquid assets alone. It's only for clients that, are looking to have some sort of trust arrangement behind our cash. And, we at Afrinvest Trustees, we've been able to look at certain things in the economy. We've been able to, go back to the drawing board and say, what, how can we help people actualize or have or to bring their dreams to reality about having a trust without necessarily them having to break the bank. And that is why this concept of private investment trust came around. So just imagine a trust structure basically surrounding your liquid assets. That is all there is to it, to the private investment trust. That's basically what private investment trust. So what are the key features of this private investment trust, and why do we think it's a good product, right? So it affords you to have a dollar and naira based investment. So you can choose to, create a trust around your liquid assets, which are in dollar, or your liquid assets, which are in naira, right? Depending on your preference. And you could also do both, right, in the circumstance. Also, we've looked at the fact that, some people may find creating a trust to be capital intensive. So we've been able to say, okay, you know what, let's give them some sort of concession. And that is why we've put the minimum initial investment to be about 200,000 naira or $1,000 equivalent, right? So, we've been able to say, okay, let's just try and help people develop, the culture of having a trust without necessarily having to break the bank. And in the effort of doing this, we've decided that, okay, there are no setup fees. So as opposed to every other trust where you need to pay a setup fee and a recurring administration fee for the administering of that trust, in this one, no setup fee, no annual administration fee. All you're just doing is you're giving your money to Afrinvest trustee. You're creating a trust around it. And telling Afrinvest trustees, give these monies to my beneficiaries based on these conditions, based on these parameters. There are different ways by which you could, structure that instruction or preference, right? So in terms of also letting people cultivate the culture of having a liquid sort of investment that has a trust element, telling people you have to lock in this investment for a tenure of 2 years, right? So some people may say, why are they locking my money for 2 years? Do they want to be using my money to invest? Absolutely not, right? Afrinvest trustees, if you listened to me earlier, we are duly regulated by Securities and Exchange Commission. So we have no doings with your money, right? Because we are not allowed to commingle our own proprietary funds with our client funds. So your funds are safe, your funds are there, you can always get a statement at any time, and nobody's going to be, touching your funds. But this idea is just, encourage the whole idea of, people having the culture of saving through a private investment trust. And obviously, to every rule, you need to have a deterrent or some sort of, I don't use the word punishment, so it doesn't have to ash, so it doesn't sound so harsh, but rightly, there'll be a 25% liquidation fee if you choose to liquidate your assets before the expiration of the lock-in period. You have to pay a 25% penalty fee, right, if you want to withdraw your money out before the lock-in period. So what are the key characteristics of a private investment trust? The characteristics of a private investment trust actually is basically, it stems out from the characteristics of a typical trust in a sense, right? So there's wealth management. Like I said, private investment trusts, it helps you manage your wealth, mostly, obviously, your liquid assets in this case, and it's very also good to know that your asset to be invested is not just that they'll just be sitting down with Afrinvest trustees whenever you tell Afrinvest trustees to disperse, Afrinvest trustees don't disperse, right? We also have a fiduciary duty to ensure that you see returns or you get reasonable value for your monies, which are being kept in your trust. Tax efficiency, I've mentioned that a couple of times at the beginning. A trust is very tax efficient, right? It reduces your tax exposure. Privacy, very important. For a trust, privacy cannot be overemphasized, right? And that is why when clients are even setting up a trust, we advise clients, or we are even very strict with the fact that we do not let clients open trust in their names, right? So you need to have a code name, you need to have some sort of coded identity to give to that trust, so that whoever sees the name on the surface of it would have no idea or any inkling that you are the owner of that trust, right? So asset protection, your assets are being kept with, a body that is duly licensed by the Securities and Exchange Commission. So you're sure that your assets are protected. And also, God forbid, if anything happens to Afrinvest trustees, parameters and measures that will be taken to ensure that your assets are safe regardless. So, I mean, it's foolproof, to be honest. It's foolproof to the 100%. Professional management, I also mentioned this earlier. Afrinvest trustees comprises of, professionals with a cumulative more than half a century trust experience. So you're obviously, assured, and you have the peace of mind that you're working with professionals who have been doing this for donkey years, who breathe and, live on trusteeship and estate planning, right? And obviously estate planning. Private investment trust, having a private investment trust ensures that, you have an estate plan, ensures that you have something in place, so that God forbid, if the inevitable happens, right, our beneficiaries are not left to squalor or to, have to source for funds as well. This is a sort of like security for the family. This is a sort of way by which we can let our loved ones know that yes, we care about them and we are thinking of them. So, at this point, I really, 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 really hope that we've been able to understand basically what a trust is, understand why you need a trust, and then most of all understand the private investment trust. So at this point, I'll be handing over to my colleague Damilare Adeogun, who would then be taking us into the next segment of this webinar. Thank you very much.
Thank you so much, Evan. A brilliant round of applause for my colleague Evan, if you can do that. Thank you so much for the insights you've drawn into, creating the very firm foundation about trust, basically about what trust and what private trust is and how our audience can benefit. So I will be going on to lay a firm foundation as to what investment entails. Okay, so I need to make a disclaimer that this does not constitute financial advice, or it's not giving you financial, well, I say, directives. These are just for teaching purposes and just for the purpose of our webinar. Okay, so what you've heard of this popular saying, let your money work for you. That's a very brilliant capture of what investment entails. Let your money work for you. And that's what investment is about. Investment is basically your money working for you. Okay. So investment is an asset or an item acquired with the goal of generating income or appreciation. So what do we mean by appreciation, right? We mean increasing the value of the asset over time. So, some people invest and you're expecting that there'll be maybe dividends or interest rates, right? But sometimes interest rate is not really the goal. Dividends is not really the goal. The goal is that I invested 50,000 in this asset, and in the next 1 year, 2 years, 5 years, it's no longer 50,000, but it's actually now worth 500,000, right? And if I can sell it over 500,000, I get to make my return. So, it's not always about interest. Capital appreciation is also one perspective about investments that you need to know about. And it is as powerful and even as rewarding as the interest that you might be so used to. Okay. So it's essentially is essentially putting aside funds to create wealth, to increase wealth, whether generating income or capital appreciation. Now, what are the traditional investments that we know about? So some of us might have heard of treasury bills. For those of us that don't know what it is, treasury bill is simply let's say a fixed interest instrument usually issued by a government of a nation. Okay, so Nigerian government can say, we want to issue a treasury bill of X amount for at Y rate, right? So that's basically treasury bill. It's a fixed income instrument. And I mean, let me take a step back by explaining that investments typically can come in two forms, right? You can have them as fixed income. You can have them as equities. Right, by equities, it doesn't necessarily mean shares, but my reference to equities here is referencing the volatility of those investments, right? So if it's a fixed income investment, I can tell you that if you are putting 50,000 into this, you are getting 10%, and then at the end of the tenure, you get 10%. But if it's like an equity or a volatile security or investment, the prices, the returns fluctuate. So you can put in 50,000 and then tomorrow it's 500,000. And you can put in 50,000 and tomorrow it's 10,000 that you meet there. Okay, so you need to be aware about this. So let's go on to bonds. Bonds basically speaks to, where a company or even a government of a nation or a state says they want to borrow funds from the public, and then a bond is basically saying is an acknowledgement of indebtedness. So is just saying that I owe you this amount, and it's also a fixed income security. Now going to equities. Equities just basically mean shares, right? Stocks. You are buying stocks in a company, so you can go to the Nigerian Stock Exchange and buy shares of the stock exchange. You're investing in stocks. And remember what I said about equity. Equity is very volatile, right? You are basically saying you want to be you want to be a part of the company. And then if the company does well, your investment does well. If the company doesn't do well, your investment doesn't do well. So on to mutual fund and index funds. Mutual funds is, I set an example. You have an investment, maybe you have a 500,000 right now that you want to invest. And what you can get for 500,000 is, say, maybe 10%. But you're seeing maybe I can Afrinvest commercial paper and they're offering what, 15, 16%. And they say, okay, the minimum you must have is 5 billion. This is, for instance, right? Now, your 500,000 cannot qualify for this investment. So what do? You put your funds into a pool of funds, right? A mutual fund that have pooled funds from every nook and cranny of the society, And then because of that pool, they are able to hit that target of minimum of 500,000. And then you can benefit from a higher interest rate, even though you have just 500,000 with you. So your 500,000 can play a part in that minimum subscription of 5 million because you have invested in a mutual fund. That is just the concept of mutual funds. Now, going on to cash, you can okay, index fund. Let me put an index fund. Index fund is basically putting your funds in your money in a fund that tracks the specific indices in the economy, right? So as those indices rise, your funds rise. As those indices go down, funds go down. So they also behave like equities. Now, holding cash, you can decide that you want to hold your funds as cash, right? Maybe you have urgent and pressing need just for maybe what's it called, immediate needs that need immediate utilities that need urgent attention. Then alternative ways you can invest. You have debt and hedge funds, right? This is basically hedging against it basically involves a lot of speculation as to what the price will be like in the future, and then I invest against that speculation, right? And then you have private equity and collectibles. Private equity is basically a way companies raise funds aside the stock exchange. So instead of putting my shares on stock exchange, I go to a private company and say, okay, I'm giving you shares in exchange for funds. Then you have precious metals. You can have gold, silver, and those precious stones also as a means of investment. People they are usually a way out of economic uncertainties and inflation. Then you have real estate. Of course, real estate just refers to buildings basically. Then you have it can be so you can have real estate funds that provide some level of liquidity. So it's not like you are buying into the building itself, but you can do further research into, and then you have cryptocurrencies, you have commodities. So commodities can be oil, gold, agricultural products. There are there's a commodity exchange where you can trade on the prices of commodities. Maybe you feel like the prices of maybe crude oil might change in the next couple of weeks, and you want to take advantage of that. There are platforms where you can invest in those options. So what are the benefits of investments, if I may? You have wealth growth. A lot of people say that if you want to grow, if you want to be wealthy, that you shouldn't save. It is investment you need to do that. They say savings don't make you wealthy, they say investments do. And while there's a level of truth to that, but what you're going to invest, you have to save it. Okay, you have to actually save what you're going to invest. So benefits of investment is that your wealth grows, and then income generation. Like I explained, as you invest, you earn returns, and then those returns, those returns are like added makes your wealth grow. And remember, I said that it's not just about income generation. Sometimes it is capital appreciation, right? So you might not be making any returns, interest rate, or what's it called, or dividends, right? But as the value increases, right, your wealth is also increasing. That's one other thing to look out for. Then diversification. Diversification speaks to the fact that your assets is diversified, and that's one advantage you have with our private investor trust. The assets are diversified across different kind of fixed income securities. We won't put your money in equities because of the risk that is involved. Tax advantages. Now, if you put your funds in a trust, you get to avoid taxation on those funds in trust. And then, it helps you achieve your financial goals. It helps you beat inflation, or where you have inflation overtaking the interest rate, at least it makes you not lose as much as inflation wants you to. And then you have compounded growth because of compounded interest. Retirement, the funds you save and invest get to yield more funds, and the compounding effect that I mentioned, and then it can serve as an active retirement plan. And then ownership and control. Our private investment trust gives you full control over what you do with the funds, basically. How you want to invest it, how you want to channel the funds, especially to beneficiaries. So, this is a broad overview as to what you get to gain by investing in our private trust. I'm going to be handing over to my colleague Chisom Wobo to continue the conversation.
Thank you very much, Dami, and thank you to everyone for staying so far, and thank you to everyone for also laying a good foundation on what we want to speak on today. So I'm going to be handling the final part of our presentation, and I'll be speaking on, since we've all had a conversation on the usual traditional investment options that we have, we're going to be looking at them side by side with the private investment trusts and see the differences and the similarities between both of them. Okay, so in terms of the features of the traditional investments, we all know that some of them have competitive returns, and the private investment trust definitely has competitive returns, and then we'll get into that. Ease of subscription, how easy is it to subscribe to some of these investments? Most of them offer easy setting and to be able to subscribe to some of them. And for the private investment trust as well, that offers that. Ease of access for beneficiaries. Traditional investments, while we've had conversations surrounding next of kin as opposed to what a beneficiary is. And most traditional investments don't have a portion for beneficiaries. They usually have places where you can have your next of kin. But for the private investment trust, we've talked about the trust element, and that is the trust element, having to set up an investment that provides for your named beneficiaries. And what does that mean? It means if anything happens to an individual who sets up that trust, those funds go directly to the beneficiaries. Now, the next feature will make my point of involvement of probate costs posthumous. This just means what happens when the person who sets up the trust dies. Traditional investments involves the probate court. Most traditional investments will ask you to bring death certificates, ask you to bring letters of administration, grant of probate, or even newspaper clippings. Okay, and that's a very long process. But for the private investment trust, that is not the case. The beneficiaries are known, and those investments go directly to them, to the beneficiaries. Now, the beneficiaries are defined, and as we go, you see how we're able to know who the beneficiaries are by virtue of our forms that you feel we know who they are. And we don't have issues of, for the private investment trust, there are no issues of contest of the funds being contested by any aggrieved beneficiary, because we already know who these beneficiaries are and the portions that are allocated to them. Now, in looking into the private investment trust features, let's just take a moment to go a step further into the features that we've discussed. We talked about competitive return because of the plethora of options of investments that the funds will be invested in. You're able to enjoy all the benefits of a traditional investment as well as the trust element. It's very easy to subscribe to. Our forms are editable and easy to fill. And like I said, beneficiaries have direct access in case of any unforeseen contingency that might occur. Now, the idea of probate courts, I think what I want to try to discuss here is there will be no need for the involvement of the probate courts if the settlor, for example, whoever sets up this investment trust is no longer here. Every of the funds move directly to the beneficiaries. In the form, you'll see that we have created a space and a space for you to include your beneficiaries and as much as you want, as well as a space where you're able to let us know at what portion do you want your funds to be divided in the case of eventuality. Now, we've spoken about undefined beneficiaries. We know them, we know who they are, and they are only the ones who can benefit from your investments. Okay, so let's go a step further to talk about the pros and cons of integrating private investment trusts into your wealth building strategy. We've spoken a lot about what different kinds of investments are. We've talked a lot about trust. Now, in deciding that you want to include a private investment trust, what are the things you should be looking out for? It's important that you know that you're able to explore different investment vehicles under this private investment trust. And you're also able to take a long-term approach. We've mentioned a little bit about compounding interest, and which we'll go further into. We have to look at a long-term approach. I remember also when everyone was mentioning some of the characteristics of our private investment trust, locking the funds down. There's a reason behind that. The reason is simple. Creating a private investment trust, you don't want to run into the habit of using those funds like a bank account. Okay, it's very easy to think that, okay, I want to save, but then if it's very easy to withdraw from, you might lose that good saving habit. So that is why taking a long-term approach is one thing that you should use as a strategy when thinking about wealth building. Okay, so exponential growth, compounded interest, we'll get into that, and you see how you can grow by having a savings attitude and savings habits with the private investment trust. Now, some of its advantage, you'll be missing out on your goals. Now, for example, you have a goal, let's say 5-year goal or a 6-year goal. This is one way you can use to achieve it. And if you don't have that saving culture, if you don't start now, you might miss out on that. So not being able to provide for your family, for example, can be one of the disadvantages. So if you don't have a private investment trust as a plan, you might end up, not being able to achieve that as well. Okay, so then let's look into working for longer than you might need to. Now, like as was mentioned, this could be some sort of retirement plan. So you find yourself, not achieving the goal of, say, I want to stop working at 30, I want to stop working at 40 or 50. So this is a plan for you. And if you don't have that savings culture, if you don't have a trust advisor to assist you in, encouraging you, so to speak, you might not achieve those goals. Now, in most cases, most investment opportunities out there are very generic. They are not tailored to use. They're not fit for purpose. Okay, so it's always important to think about not just accumulating, but what happens in the future. And that's something that the private investment trust can do for you. Now, I wanted to speak more on having an investment strategy that isn't fit for purpose. There's a lot of investment options out there. And I've looked at some of the questions that we've been asking. And, a lot of people are very, very interested in different sorts of investment. But it's always important to know what fits you. What are your goals? Are you just investing just for the interest, or are you investing for a goal? So I always like to say, why are you working? Why do you do what you do? What is the end goal? And that is how you're able to answer the kinds of investments that suit you. Now, you have to always think about accumulating, saving, and succession, for your investments to be able to pass on easily and seamlessly to your beneficiaries. So, it's one thing to be able to commit to a plan, like to say, I want to commit to a plan like a private investment trust, or transferring your pension, or even say you want to write a will, for example. But, having that goal in mind is one thing, but taking the next step is another. So I think this is a call to action for everyone to think about what their goals are and have investment options that align to it. And I don't think I know that the private investment trust is what is fit for a lot of us. Okay, so let's look at the disadvantages of not including a private trust. Your loved ones, you leave them to the hands of time. In some cases, you leave them to the courts to decide what happens to you, your wealth, or you leave them running helter-skelter when it's not necessary. And now we've spoken about charitable trust. Now, there are people who, they've accumulated so much wealth, but they don't know what to do with it. You can start thinking about investing or keeping money aside for a charitable cause. It could even be for your aged parents. You can start to look at that. And one important thing that sets the private investment trust apart from other investment is the fact, and we cannot overemphasize this, is having your beneficiaries listed. Okay, so if your beneficiaries are listed and known by the trustees, the trustees now have a duty to ensure that those funds are, or whatever asset that it is, but for the purpose of this webinar, the funds that you've put aside have direct access to it. So that's a very important point to note. And not having this plan can leave a lot in the open for your family in the long run. So now let's look at practical steps to initiate and manage your own private investment trust. Now, while looking at that, we spoke about compounding interest. Now, this is, like we've always said, it does not constitute financial advice. This is for illustrative purposes only. But this is just an overview of what happens if you decide, you know what, Afrinvest trustees, I've been hearing this over and over again. I am ready to start. Now I want to start with 200,000 naira every month consistently. Remember, there's a locking period for 2 years, and you're not worried about that. So 200,000 naira monthly, you're looking at total interest, and now 10% is, like I said, for illustrative purposes, you're going to have a total interest of 12,106,849. Okay, now that's what you have. That's what the total interest has come up to. And now for a 200,000 naira monthly contributions for 10 years, you're looking at 24 million. Okay, and the cumulative value at the end of 10 years is 36 million. So this is one of the best ways to have a goal and stick to it. Now, even if you think that at the end of 10 years, you're not, maybe your goal has changed, life has happened, that 6 million gives you purchasing power to do whatever you want, or even put back into maybe your business or family or whatever purpose. So it's very, very important to look at that savings culture and actually have it. So when you have that savings culture, you know that your goal can easily be achieved. So what are the steps? How do you start off? Very easy. Send us an email at trustees@afrinvest.com. We are going to send you our account opening form for you to fill. It's easy, like we said, but we're also very happy to assist you in case you have questions regarding filling the form. And then we would need submission of your KYC, that is know your customer documentations, means of ID, valid means of ID, your photograph, driver's license, or permanent voters card. That is the kinds of identification that we take. And then your utility bill of not more than 3 months. Now, for your beneficiaries, which is very, very key, we also need to know them. And the only way we can know them is if we have documentations for them. So for little children, we take birth certificates. For older children, if you have means of identification for them, we have them. Okay? And then what is the most important step? Transferring of the funds into the trust account. Now, a trust does not exist in a vacuum. For a trust to actually be created, it needs to be an asset. And this asset for this investment is liquid cash. Okay, so now you transfer the funds into the accounts that we will provide, and then you have literally set up a trust. So it's as easy as ABC. So at this point, I want to say thank you so much for sticking with us, and we would open the floor for questions and answers. Thank you. Over to you, Danny.
Thank you so much, Kiso. Brilliant presentation. So quickly, let me just go over this by saying, so nobody else asks those questions. You will get the webinar recording and slides after the session, okay? So you don't need to ask that, okay? Once you register for the event, you're going to get it after the event. Okay, so taking questions, let me ask, Eb, I'm handing this question to you. So this person says, can I still create a trust after registering a will in court?
Okay, thank you very much, Dami, and I need to applaud the person for that brilliant question. Can you still create a trust despite having an existing will? Oh, yes, you can. Yes, you can. Yes, you can. However, there's a caveat to it, right? First of all, a trust and a will, they are two different estate planning tools, right? In as much as they sort of like have the same end result or end goal, they are two different. For a will, right, you've already lodged and you've already stated by law that these are the assets that you want, you know, your beneficiaries to state, right? So for you to create a trust after your will, you need to be sure that whatever you are putting into the trust, whatever asset you want to put into the trust was not already pre-existing in the will. If not, there will be conflict, right? Because if the executors are going to, at the point of where your executors will be executing your will, if at any point they are trying to trace what you've already written in your will, and unfortunately you've included those same assets in in a trust, those investigation or those traces of those assets may actually trace to the trust and the executors, because they have a court order, right? And if you remember when I was explaining, I said if a court order comes into the play, those are one of the very, 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 very rare occasions where a trustee will be forced to, disclose the tenets of what is in the trust. So yes, you can have a trust despite having a will, but you need to be meticulous enough to understand and know that whatever you've already put in your will, you should not put that in a trust to avoid conflict of interest.
Thank you so much, Evan. Brilliant answer. Brilliant answer. Okay, so this person says, how can we subscribe? How can we access and subscribe the PIT on Afrinvest? So this is the email address you should send your request to, and we would respond to you. What's going to be the ROI during the lockdown period? Again, what are the investment window and trust funds we put into? Okay, so ROI, now what's it called? It varies, because as at the time you ask, that's when we're going to give you a rate. But if you want to find out, you just send us an email and let us know how much you're interested in depositing, and we'll get back to you on the ROI for that. Now, how does one subscribe to the private investment trust? I already explained. Is it investing generating interest generating? Yes, it is, right? Your funds are going to earn interest. You're not just going to sit down idly there, right? And can it be monitored in real time? No, it's not in real time, but you can request for your statement, and then within 24 hours you get a statement. Is there anything in the agreements that will restrain a beneficiary from instituting a litigation if he or she is not satisfied with the percentage allocated? Litigation file. But here's the deal: we advise you on the rate. If you're not happy with it, we can't force it down your throat. But I don't see how litigation would come into this. Okay, so if we tell you or giving you 10%, it's 10% you're going to get. Okay, Afrinvest. Someone asked what happens if the trust company is no more. Afrinvest has been here for over 25 years. We're not going anywhere. Come and check in the next 100 years. You still meet Afrinvest here. Okay, so we're not going anywhere. And I mean, we have our reputation to protect. If we tell you we're giving the rate is 10%, you're going to get 10%. Okay, it's not. It won't be short of it. Of course, except if withholding tax charges apply. Okay, so let's check out questions from the chat session. I've been checking. What investment can invest within 6 months to get profitable? Well, I mean, depending on your definition of profitable, so long as interest is being earned, I think it's profitable. So, and whenever you put some funds with us, they're going to be invested, and then you can get, like I said, if you want specific rates, you're going to have to contact us specifically. Okay. Please summarize the investments and amount required, one time or continuous payment. Ebu, can I channel this to you? Like, this person wants some clarity on the amount required. And then let me just start another question to it. And that question is asking, will there be a penalty for missing a payment, right? We said it's supposed to be monthly. Will there be a penalty for missing?
Yes. So to the first question, and I think this is also related to quite a number of questions that I've seen coming in. Once again, for this product, what we're trying to do is we're trying to make sure that it reaches the average income earners, right? So we are not charging for this service. Once again, there is no setup fee, and neither is there any annual fee, right? And in as much as we have a minimum contribution of 200,000, and then we are saying that you need to contribute monthly, all of these are just they are ways to encourage you. But obviously, it's very possible that you may not be able to meet up with 200,000 anymore. It doesn't mean that you'll be penalized, right? The only penalty here is if at any point before the lock-in period of 2 years, you are looking to liquidate your funds, then we would have to, you know, sort of issue a 25% penalty. But generally, you know,
Let me emphasize, the penalty is on the interest earned, not on your principal.
Yes,
Just
yes.
wanted to get, because someone asked that question.
Okay, yes, please. So you know, you pay a penalty of 25% and then you get your funds, right? But I mean, that's not why we're here. We're not here to lock in and lock out. If we were to do that, we'll probably go to an asset management house. What we're trying to do is create an avenue that our beneficiaries can have something, to create an avenue, a trust, right, that we can, you know, leave for our beneficiaries, and we can also, you know, give our beneficiaries access to, even whilst we're still here. So basically, yes, those are the answers to the questions.
Okay, brilliant. Thank you so much, Ebu, for those answers. Okay, so we have a lot of questions that we might not be able to take, but as our practices, in the email we're going to send to you, we're going to get your answers to these questions. Okay, we'll have a list of questions asked, and then we'll give you responses to those questions. So please be rest assured that all your questions will be answered. Okay, in the interest of time, we just might not be able to extend beyond now. So again, we want to say a big thank you to everyone that has joined. Thank you so much for staying with us all the way to the end of the webinar. Like I said, it's the Afrinvest webinar series, Afrinvest Trustees webinar series, and it happens every quarter. So Q2, be rest assured that we're coming back again with a power-packed and really informative content for you. So stay tuned, look out for our emails, and please, if you have any questions, you have any inquiries, you can send an email to trustees@afrinvest.com. Thank you so much again to our audience. We love you, and see
Thank
you again
everyone.